Good evening, everybody. Thanks for joining me. My name is Brandon Moncrief with McLaren and Associates, and I'm going to spend the next hour or so giving an update on the DSO market. So appreciate you tuning in. We're going to unpack a lot of information tonight, a little bit of housekeeping before we get started. I would love to have as much Q&A as possible throughout the presentation. So on the right-hand side of your screen, if you click on Q&A, you can type where it says ask a question and hit send. And I'll be checking those questions throughout the night. I will also remind you a little bit later in the presentation to prompt you to ask questions. So ask questions along the way. I'll try to get to them as I go through the presentation. And then I'll pause at the end as well to answer any questions that I was not able to get to during the meat of the presentation. So with that, I will jump right in. To tell you a bit about me, again, my name's Brandon Moncrief. I'm the principal and CEO of McLaren and Associates. I have spent my entire professional career on the business side of dentistry. I spent about a decade as a banker, lending the money to dentists all across the country to acquire, start, and expand practices. And then 13 years ago, coming up on 14 years now, I purchased McLaren and Associates. So at the time I purchased McLaren, it was kind of a small mom and pop practice brokerage firm focused on doing doctor to doctor, more traditional practice sales exclusively in Texas. And over the course of about 6, 7 years, I scaled that business significantly, got to the point where we were doing about 50 to 60 doctor to doctor practice sales a year. And being in Texas, we were on the forefront of a lot of this wave of DSO consolidation in the dental space. So we started to see our large elite practice owners that we thought were going to sell their practices to another clinician pivot and sell their practices to DSOs. So with my background in finance and banking, I realized that for large practice owners, DSOs, private equity is kind of the future of our industry. So at that point in time, that was about 7 years ago, I decided to build out a team and build out a process to provide sell-side advisory to large practice owners, multi-site, multi-doctor, multi-million dollar practices that are inevitably going to look to go down the DSO road as opposed to sell to another clinician in a more traditional private practice sale. So over the past 15 years, I've brought on several partners in my business. My brother is my primary business partner, and then we have other minority business partners. Most of our team are former bankers, finance people. We have a CPA on staff. We have financial analyst on staff. We have a couple of people that used to sit on the buy side working for DSOs buying practices. Now they've stepped on the sell side. Who better to have on your side of the table than somebody that knows the ins and outs of the private equity world and has sat on the buy side of the table. So we've got a team of 15 across the country. We have our primary office in Austin, Texas. That's where I live. That's where HQ is, and that's where most of our people sit. But we also have an office in Los Angeles, an office in Cleveland, and an office in Atlanta. So we truly work nationwide. We serve all dental specialties. We do a lot of general dentistry transactions, but we also do a lot of pedo, OMS, perio, ortho, any type of business that's focused on delivering dental care, we can perform at a high level. And I do want to make the point that our legacy business, that doctor to doctor business, still exists. So we still transact 50 to 60 practices in the doctor to doctor world all over the country on an annual basis. And we transact about 40 to 50 DSO and private equity deals all over the country across all dental specialties. So over the past 7 years, we've closed over 200 DSO and private equity transactions. We've really seen everything that can go right and wrong in a practice sale, whether you're going the doctor to doctor route or going the DSO route. So tonight, we're going to focus the conversation on talking about DSOs and private equity. I'll give you an update on current market conditions and give a little background about the history of consolidation in our space. We'll talk about what DSOs are looking for, why doctors choose to affiliate with the DSO. We'll talk about DSO deal structures, then I'll go through a handful of case studies. As I mentioned at the beginning, if you have a question tonight, on the right-hand side of your screen, you can click Q&A down at the bottom, type in your question, hit send, and I'll try to get to it as I go through the presentation this evening. I look at our job first and foremost to educate large practice owners on what is your business worth, right? What is your EBITDA? What are your options? And ensure that you go down the appropriate route, whether that be selling to a private buyer or selling to a DSO. You do it at the right time and you maximize your outcome. So, for lack of a better word, our job is to create a bidding war if and when you're ready to take your practice to market, to help you find the buyer that's the right fit for your business, negotiate the most favorable deal structure possible that aligns with your why and your goals, and then obviously leverage that competitive environment to maximize the valuation of your practice. So I want to level set because we've got about 75 doctors on the call tonight, and all of you have varying degrees of education and understanding regarding the DSO and private equity space. So I think it's important to just unpack some terminology. EBITDA is a huge buzzword in our industry because private equity is now buying dental practices, and PE values dental practices through the lens of a multiple of EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. But think of EBITDA as absentee owner profit, right? If you did not work chairside in your business, how much profit is your business generating once you pay all the overhead, the real overhead of the business, after eliminating any non-cash expenses like depreciation and amortization, after adding back any personal or discretionary or non-recurring expenses, as well as doctor compensation, including paying yourself a market wage to do the dentistry that you're currently responsible for. I think that's where a lot of people go wrong when they calculate EBITDA. They forget to pay themselves a market wage to do the dentistry that you're doing chairside on a daily basis. So think of EBITDA as absentee owner profit. DSOs and private equity value businesses through the lens of a multiple of EBITDA. So first you calculate the EBITDA, and then you apply a multiple to that EBITDA to arrive at valuation. We'll talk in a little bit about what impacts the EBITDA multiple. Most DSOs are backed by some type of institutional capital, whether that be private equity or a family office. A private equity firm is essentially a group of business people that raise a fund. They might raise a fund of, 100 million to 200 million dollars, with the goal of deploying that capital across multiple companies, likely in the healthcare space, utilizing what they call a buy and build strategy. So in the DSO space, the majority of the time, a PE firm is going to start by buying a platform. And that's going to be likely a 3 to 5 location practice in a top 25 MSA with top line revenue of at least 5 to 10 million and minimum EBITDA of at least 2 million. They're going to acquire that business and they're going to build infrastructure around that business and then start building density around that business via additional acquisitions, first likely starting off in that same geographic footprint and possibly laying on a de novo strategy, starting practices from scratch as well. And then they may go out at that point and buy other platforms in other major metro areas and build the company up, build infrastructure around it, leverage economies of scale to drive higher revenue and lower overhead, and eventually sell that business at what we refer to as a recapitalization event at a handsome return. Typically, private equity is looking to monetize these DSOs in a 5 to 7 year window. Used to be a 3 to 5 year window, but given the current macroeconomic conditions with elevated interest rates and tightened capital markets, those recap cycles have prolonged to some degree. So now most DSOs are eyeing a recap event somewhere in, I'd say, a 5 to 7 year window, and they want to generate somewhere between a 3 to 5x return on invested capital. And that gain, that return on invested capital, is often referred to as arbitrage. So just think of arbitrage as a fancy synonym for the word gain. At a recapitalization event, not only does the financial sponsor, the private equity firm, have the opportunity to liquidate all or most of their investment in the DSO, but the management team of the DSO is typically holding equity in the company and they have the opportunity to liquidate their equity in full or in part. And the doctors are typically holding equity in the company and they have the opportunity to liquidate their equity in full are in part. And at that recap event, really the only thing that changes is one financial sponsor, one private equity firm steps out, and the new financial sponsor, the new private equity firm steps in. So the way it typically looks is a PE firm is going to buy that platform, let's say for an initial valuation of 8 to 10 times EBITDA. Then they're going to buy another 50 to 100 practices at a cost average of, let's say, 7 times EBITDA. So all in, they might be cost averaged at, let's call it 8 times EBITDA. And because of their size and their leverage, they're going to be able to recap that company and sell it to the next financial sponsor for somewhere in the range of likely 12 to 15 times EBITDA. And then the new financial sponsor is going to repeat the cycle, right? Now their cost average across those 50 or 100 practices at 12 to 15 times EBITDA, they've got to go out and they've got to buy 200, 300 practices, again, at a cost average of 7x to bring the global cost average across the entire platform down somewhere in the range of 9 to 10 times EBITDA. And then they're going to sell it again in that 5 to 7 year window at 12 to 15 times EBITDA. And they're going to generate a nice return on capital. We'll talk about how they're leveraging the business and juicing those returns here in just a minute. All of these companies are fueled by a combination of equity. Think of equity as either cash or the value of equity in your business that you're exchanging for stock in the DSO, and leverage. All DSOs are highly leveraged. Leverage is debt. And we'll talk in a minute about how the current macroeconomic environment, the elevated interest rate environment, has played a major role in shaping the behavior of buyers and valuations over the past 24 months because DSOs are typically heavily leveraged. All DSO deals are going to involve a cash component and an equity component. And that equity is either going to be joint venture equity, retained equity at the practice level, or holdco equity, equity at the DSO level in the parent company of the DSO. A little bit later, we're going to talk about DSO deal structures and talk about how those different forms of equity function. But let's talk for a minute about how private equity makes money. I already talked about the fact that they buy low and sell high, right? They buy practices for 7, 8 times EBITDA, and at recap, they sell them for somewhere in the range of 12 to 15 times EBITDA. Well, simple math. Let's say the DSO is buying practices at 7 times EBITDA, and then 5 years later, they're recapping and selling the business for 14 times EBITDA. You double your money, right? You bought for 7, you sold for 14, you doubled your money. Not exactly. Through the proper use of leverage, they're able to juice the return substantially to where what looks like a 2x return is actually a 4 or 5x return. And I'll relate it to buying and selling a home. So let's say that you buy a house for $400,000 and 5 years later, you sell that house for $800,000. Simple math, bought for 400, sold for 800, you doubled your money. But that's only if you paid cash. Only if you paid 400,000 cash for that initial investment, then you truly generated a 2x return on capital. But we all know you typically don't pay 100% cash to buy a home. You're going to leverage it, right? So let's say you put $100,000 down and you borrow $300,000 to buy that $400,000 house. 5 years later, you sell that house for $800,000 for a $400,000 gain. What was your initial investment though? Your initial investment was only $100,000 in cash because you leveraged the rest. So on that $100,000, you generated a $400,000 gain. That's a 4x return on invested capital. Private equity does the same exact thing. They make money through the appreciation of the asset in combination with the proper use of leverage. So let's talk a little bit about the evolution of the dental industry because it has certainly evolved rapidly over the past 10, 20 years. So I've been in the space 23 years now, and it is remarkable how much it's changed since I entered the space back in 2002. So DSO version 1.0. This is the version of DSOs that I think made DSO kind of a 4-letter word. It gave DSOs a bad reputation. The early iteration of DSOs, the suits were making all of the decisions. The doctors did not own equity at the practice level nor equity at the DSO level. The DSOs were involved both from an operational perspective and from a clinical perspective. They typically utilize the de novo model. They were not buying practices. They were starting practices from scratch. They were developing their own culture, their own systems. They were not doctor centric, staff centric, or patient centric. And as a result, most DSOs that followed that script crashed and burned, right? There are very few DSOs that have been around for 20, 30 years. So for the first 6, 7, 8 years that I owned McLaren, I would not even bring up the DSO option with most of my clients for fear that they would cuss me out and kick me out of their office because DSOs had a bad name. But this new version of DSOs really came to market about 7 to 10 years ago. And they function very differently than DSO version 1.0. Now, don't get me wrong, there's still some DSOs that look, feel, and behave like DSO version 1.0. There are still some bad actors out there. But what I'm going to describe is the type of DSOs that we allow to bid on our clients' practices. And this is DSO version 2.0, where private equity realized that we can partner with great clinicians, great practices, and we don't have to reinvent the wheel. We can perpetuate their success through honoring their culture and not interrupting their clinical autonomy, supporting them behind the veil from an operational perspective, and through leveraging economies of scale associated with their size, negotiating better reimbursement rates with payers and better pricing with vendors, buying low, selling high, properly leveraging the business without completely trying to reconstruct the business, they can make a ton of money. So this new version of DSOs is very doctor centric, it's very staff centric, it's very patient centric. It's focused on not being patient facing, staying out of the operatory, supporting the practice behind the veil from an operational perspective, and then also allowing the doctors to invest shoulder to shoulder with private equity and realize the same returns that the private equity investors are realizing at recap. It's a completely different business model than version 1.0 and a much more legitimate options for doctors to consider. So come 7 years ago when DSO version 2.0 came to market, that's when we said, all right, DSOs that follow this script have their act together and have become a legitimate transition option for our clients. We need to start educating clients about this, but we need to make sure that if they're going to take their practice to market, we control the narrative regarding EBITDA and we create as much optionality and competition as possible because private equity DSOs are opportunistic, right? Their goal is to buy low and sell high. And if you don't have proper representation, you run the risk that you sell to the wrong DSO, maybe you sell prematurely, maybe you sell at the wrong time, you accept the wrong deal structure, and you leave a lot of money on the table. So DSOs, private equity, love dentistry because it's kind of a perfect fit for the type of business they invest in. It's a very fragmented industry. It can absolutely benefit from mass organization and leveraging economies of scale. It's a highly profitable business. It is recession proof and now proven to be pandemic proof. So it fits the mold for what private equity was looking for. So simultaneous with private equity falling in love with dentistry and this new version 2.0 of DSOs coming to market, there was another interesting thing that happened that led to the massive consolidation we've seen over the past 5 to 7 years. And that is the rise of group practices and emerging DSOs. I mean, up until 5 years ago, 7 years ago, I didn't come across a ton of practices that had top line revenue of 3 million plus, that had multiple doctors working under one roof, that had 8, 10, 12, 15 operatories, that were multi-specialty. This is a relatively new phenomenon, and I think it's caused by the fact that the younger generation of dentists in that age group of, let's say, 40 to 60 are far more entrepreneurial than their predecessors. And a lot of them were wise to the fact that if you wanted to thrive long term in dentistry, you needed to kind of emulate the DSO model and build a large group practice. So now we've got a ton of multi-doc, multi-million-dollar revenue practices with large facilities And that is an ideal fit for what DSOs are looking to acquire. So those two market conditions converged about 5 years ago and led to mass consolidation in combination with the fact that at that time, private equity was sitting on an enormous amount of dry powder, an enormous amount of investor cash. And macroeconomic conditions were ideal in the sense that interest rates were at an all-time low, the capital markets were wide open, debt was cheap and easy to access. So that's what's led to the market conditions I'm going to talk about in just a second. So pre-COVID, private equity loved dentistry. There were about 200 DSOs operating across the country. Practices were trading somewhere in the range of, let's say, 5 to 8 times EBITDA on the high end. But PE really, really liked dentistry and was investing at a pretty rapid clip. And then COVID happened. And dentistry had already proven to be recession proof, but then it rebounded as fast or fast than any other healthcare vertical coming out of COVID. Most practices had their best year in the back half of 21 up through the end of 22. So private equity already loved dentistry. And then they saw how fast dentistry rebounded post COVID. They were still operating with ideal macroeconomic conditions, low interest rates, wide open capital markets, cheap debt, and they doubled down. So they started buying practices at an even faster clip. 21 and 22, the post COVID market conditions were extremely frothy. DSO demand for practices was sky high. And as a result, valuations across the board increased by about 30 to 40% in 21 and 22. And I will say that was probably the peak of the market from a valuation perspective. Most practices trading in the 7 to 10 times EBITDA range. And we were seeing anywhere from 7 to 15 offers on every single practice we took to market, and almost everything was sellable. So market conditions super frothy from, I'd say, back half of 2021 through the front half of 2023, with 2022 kind of being the peak of the market. And then what happened in early to mid 2023 was that interest rates essentially doubled overnight. And we're talking about highly leveraged businesses that carry a lot of debt. And they were unfortunately not prepared for that massive shift in macroeconomic conditions. By the way, they're also coming off of 21 and 22, where they bought an insane amount of practices at elevated multiples. And a lot of them were not integrating and operating the businesses as they were acquiring them. So we saw quite a bit of market turmoil over the past 18 to 24 months. There were a handful of DSOs that failed. There were many DSOs that were on pause from a buying perspective because they had to regroup. They had to refinance their debt, and they had to actually integrate and begin to operate the businesses that they acquired in 21 and 22. There were many DSOs, though, that were built on a solid foundation that still operated with discipline in 21 and 22. They weren't paying elevated multiples, and they were actually integrating and operating the practices that they were acquiring. Therefore, they stayed with a green light with their banks and their PE firms and continued to buy practices in 23 and 24. Those DSOs that were sidelined by this change in macroeconomic condition were backfilled by smaller emerging DSOs that took on PE capital in 21 and 22, still had plenty of debt, plenty of access to leverage with their banks, and plenty of cash from their private equity sponsor. They were kind of able to step up in 23 and 24 and fill that void that some of those DSOs that were sidelined left in the marketplace. So we did see a little bit of a downturn in demand and valuations. I will say that demand might be down 20%. Valuations might have softened by as much of a turn of EBITDA over the past 24 months, but still compelling market conditions to be a seller today. Deals are still happening. Valuations are still good, especially for Class A assets. And we'll talk in just a second about what it means to be a Class A asset. I want to remind everybody, if you have a question throughout the presentation, on the right-hand side of your screen, click Q&A, type where it says ask a question, hit send. I'll see it and try to get to it throughout the presentation, and I'll pause at the end to make sure I get to your questions. So let's talk about the current market conditions. What does it look like today? And I hear a lot of noise out there that deals aren't happening, or you know, 7x multiples are no longer available. And I'll be honest, that's absolute bullshit. We had a banner year in 2024, and we are on pace to have an even better year in 2025. So we are transacting with more practices at great valuations and good deal structures. No, it's not as crazy and frothy as it was back in 21 and 22, but it's still compelling to be a seller dependent upon your why and dependent upon your EBITDA margin, and how your practice is positioned. So we are now in, I would say, a stable and or declining interest rate environment. So a much more favorable environment than we were in the past 24 months, where we were in a rapidly increasing interest rate environment. I know Trump is putting a serious amount of pressure on the Fed to decrease rates. Looks like inflation is now in check. We'll see how all the noise plays out with the tariffs, but I think that we're going to see another rate cut in 2025 and multiple rate cuts in 2026. That is welcome news to private equity firms, given that they carry a lot of leverage on these DSOs. From a PE perspective, we had a favorable election outcome. Private equity felt that they would be operating with better macroeconomic conditions under a Trump presidency than they would under Kamala. So, definitely a favorable election outcome from that perspective. And as a result of these two factors, we've seen renewed private equity interest in our space. We had multiple recapitalization events at favorable multiples in Q1 of 2025. There are several prominent DSOs that are currently under letters of intent and expected to announce a recap over the next 60 to 90 days. And there will be several reputable DSOs take their business to market over the next 3 to 6 months. So I think you're going to see, probably 15 to 20 recaps announced over the next 12 to 18 months. And I think while those businesses won't trade for 15, 16, 17x, the crazy multiples that DSOs were trading for at recap in 21 and 22, they are going to be trading somewhere in the 12 to 14x range. And I think that's going to equate to somewhere in the range of a 2.5 to 4x return on invested capital. So still good returns, good multiples. I'm welcoming the news of these recaps in 2025 and coming up through 2026. That said, DSOs are facing increased scrutiny at recap by institutional investors. So in 21 and 22, the institutional investors were buying everything they could get their hands on and paying elevated multiples and not really paying attention to the how effective these DSOs were at integrating, operating, and growing the businesses that they were acquiring. But same store sales growth is now a huge talking point when DSOs go to recap. So the institutional investors are looking at the portfolio practice by practice and saying, why did you buy this practice? Was it a prudent investment? Did it match your investment thesis? And how has the business performed since you acquired it? Have you grown top line revenue? Have you grown EBITDA? If the answer is yes, across the board for the majority of the practices the DSO owns, it's got a high probability of recapping at a handsome return. If the answer is no, and the majority of the practices they've acquired have moved backwards post affiliation, that's going to be a problem. So because DSOs are facing increased scrutiny by institutional investors when they go to recap, they are being more pragmatic about evaluating the acquisition opportunities that come across their desk. So not every practice is sellable in today's environment. While Class A assets are still trading at elevated multiples and strong deal structures comparative to pre-COVID market conditions, Class B and Class C assets are harder to move. And we've seen more adjustment in price and deal structures in those assets than we did in 21 and 22. So still strong buyer demand and attractive valuations for quality assets. Deal structures have evolved, though. Deal structures look a little bit more like they did pre-COVID as opposed to post-COVID. And what I mean by that is because the capital markets have maintained some level of tightness, because debt is still somewhat expensive and hard to access. Buyers are trying to preserve cash, meaning that in 21 and 22, the average cash at close was around 70 to 75%. But today, the average cash at close is around 60% of the global valuation. The equity component is going to make up the lion's share of the remainder of the deal structure, but you are seeing earnouts, seller notes, pref A equity, some of the elements of the pre-COVID deal structures start to creep their way back into these deals. The way to mitigate that is to work with a strong sell-side advisor like us, create a very competitive environment so that you can negotiate the most favorable deal structure you possibly can. So let's talk a little bit about why our clients choose to affiliate with a DSO or partner with private equity directly. A higher practice valuation. So let's do a comparative analysis. Private buyer world versus DSO world. Let's take a practice with top line revenue of $3 million and EBITDA of 700,000. That's a little bit over a 20% EBITDA margin. In the private buyer world, if you're going to monetize that business by selling internally to associates or selling to a third party doctor, one, it's going to be difficult to find a doctor or doctors that have the confidence, the competence, the skill set, the financial backing to knock down a practice of that size. And let's not act like it's easy to go find a buyer. It's also not easy to internally sell your business to multiple associates. There's a lot of moving parts, a lot of people involved in that. It's difficult to get to a closing. It's possible, but it's difficult. But let's say you were able to find a private buyer or multiple doctors internally selling to your associates. On a good day, your practice is going to trade for a valuation of 2.5 million. Whereas in the DSO space, at $700,000 in EBITDA, a top line rev practice of $3,700,000 in EBITDA, let's say it's multi-doc and 8+ operatories in a major metro area. I mean, that practice is going to fetch somewhere in the range of 5 to 10 offers and likely trade for at least 7 times EBITDA. So you're looking at a $4.9 million valuation in the DSO world comparative to a $2.5 million valuation in the private buyer world. Now, in the DSO world, absolutely, it's going to come with more strings attached, right? You're going to get somewhere around 60, 65% cash at closing. There's going to be an equity component that has risk, but also has substantial upside. And you're going to be required to stick around for 2 to 5 years. The going rate these days is a 5-year commitment, but that doesn't mean working chair side 4 or 5 days a week for 5 years. That just means that you're going to have a vested interest in the business on an ongoing basis for up to 5 years post sale. Whereas in the private buyer world, it's likely going to be 100% cash at close and a limited post-closing commitment, right? So pros and cons to each of those options. But once you cross about $2 million in revenue, demand starts to wane in the private buyer world and valuations start to decline. Whereas in the DSO world, demand increases and valuations run away from the private buyer, the traditional valuation, very quickly. Many of our clients, their most valuable asset on their personal financial statement is their practice. They have a tremendous amount of their net worth tied up in a relatively illiquid asset that has a ton of key man risk. And whether you want to admit it or not, whether you're working chairside or not in your business has a tremendous amount of key man risk. As the founder, you are the beating heart of that business. Even if you've shifted the production to associates, if and when you exit that business, God forbid if something were to happen to you, there's no doubt that the value of the business declines rapidly overnight. So for a lot of our clients that have the majority of their net worth tied up in this business, they want to de-risk. They want to take some chips off the table. They want to monetize 50 to 70% of the value of the business and diversify their wealth by investing that cash in other asset classes outside of their business, outside of dentistry. And that's just wise, right? If you talk to any financial advisor, the number one thing they're going to preach is diversification, diversification, diversification. So by taking some chips off the table and monetizing your business, you are de-risking. There's also massive tax arbitrage that happens when you sell your practice to a DSO. And I think this is often overlooked. So what you're doing when you monetize your business in the DSO space is you are trading future EBITDA, future earnings, right, for cash today. Well, those future earnings are ordinary income, taxed at your highest tax rate. depending upon where you're at in the country, could be as low as 35%, as high as 45%, depending on what your state tax looks like. You are converting that ordinary income into cash today, taxed at a capital gain. The vast majority of the sale of your business in the DSO world, somewhere in the range of 85 to 90% of the deal, is going to be allocated to goodwill and taxed as a capital gain, 20% in most cases. So that's about a 20% savings from a tax perspective via monetizing your business in the DSO space. That is material, that is real, and it's significant. A lot of our clients are looking for operational support, especially post COVID. Most of you have been dealing with an HR nightmare. The larger your practice, the larger your team, the larger that nightmare is. So a lot of our clients are looking for help with negotiating with payers, right? Getting better reimbursement rates from PPO plans, better pricing from vendors because of their size, because of the economies of scale they create. DSOs are better positioned to negotiate with payers and vendors and fight some of the headwinds that private practice is facing. So a lot of our docs want to get, you know, the legal, the bookkeeping, the accounting, the compliance, the payables, the HR administration, benefits administration. They want to get that stuff off their plate, as well as get access to the economies of scale that DSOs can bring to bear. I do want to make the point, though, that affiliating with a DSO, partnering with private equity, is not always a conduit to taking a step back in your business. For many of our younger entrepreneurial clients, they're at a point where they've built a large business. Maybe they have a multi-site or at least a multi-million-dollar revenue practice, and they want to scale their business, but they know that that means they're going to have to build their own infrastructure. They're going to have to hire middle management, and that's going to temporarily erode EBITDA. And rather than taking that risk and spending that money and time on their own, they've reached an inflection point where they've decided, well, why do that on my own when I can de-risk, take some chips off the table, and then leverage the capital and the infrastructure and economies of scale already in place by the DSO they're going to partner with, leverage that DSO's capital, infrastructure, and economies of scale to step into their business and scale it further. So it can be a conduit to taking a step back, but it can also be a conduit to leaning into your business and scaling it. And then, as I mentioned before, all of these deals are going to have an equity component. Yes, the equity does have risk, but I would say the potential reward far outweighs the risk. I mean, what asset class can you invest capital in and expect a 2 to 4x return over a 4 to 7 year window? I mean, it's almost impossible to fetch that type of return. So the risk reward proposition is pretty compelling, but you got to pick the right pony. You got to pick the right DSO. Some DSOs are going to go to zero. It's already happened. A handful of DSOs have failed. Some DSOs are going to generate a remarkable outcome, a 3, 4, 5x return on invested capital. All other outcomes are going to fall somewhere in between. So my number one goal is obviously you got to pick the right partner, find the right fit so that you're happy post sale and maximize the upfront valuation. But I've also got to only show you the best of the best options that have a high probability of hitting a recap event at a handsome return. So we spend an inordinate amount of time vetting DSOs and only allowing the best of the best in the room to talk with our clients and bid on our practices. So, how to position your practice as a Class A asset? What are DSOs looking for? Number one is geography. And I know this is something that you can't necessarily control, but most DSOs are looking to acquire practices within, I'd say, 30 to 60 miles of a major metro area. So they're looking for practices in urban and suburban markets. Now, that doesn't mean that if your practice is located in a tertiary market or a rural environment, you can't sell to a DSO. It just means that other things equal, your practice will likely see more offers and a higher valuation if located in an urban and suburban market as compared to your peers in tertiary markets. Multiple doctors, the mitigation of key man risk. DSOs are paying very, very close attention to key man risk. And single doctor practices, especially if you're a super producer with an expanded skill set, those practices carry a tremendous amount of key man risk comparative to a bread and butter practice where the production has been spread across multiple providers. So DSOs are looking really hard at key man risk. You know, how is the production bifurcated across multiple providers? What is the age of the primary producers? What is their runway to exiting the business and or retiring? So the more doctors, the better. The less dependent the practice is on, one or two providers, the better. All things equal, you're going to see more demand, higher valuations on that multi-doc practice comparative to that single doc practice. Now, again, just because you're a single doctor practice doesn't mean you can't pursue a DSO affiliation. It just means you won't see as much demand. You won't see as high of a valuation comparative to your peers that have less key man risk in their business. EBITDA of $500,000 plus. So I would say a few years ago, that threshold was more like $200,000 to $300,000. But the reality is, for a DSO, it takes the same amount of effort, the same amount of capital, same amount of brain damage to get to a closing on a practice that's got $1 million of EBITDA versus a practice that's got $200,000 in EBITDA. So they would rather buy larger practices as opposed to smaller practices. So if your EBITDA is under 500,000, that means that you're likely going to see less demand and a lower valuation comparative to your peers that have a higher EBITDA level. EBITDA margin of 20%. So DSOs are paying very close attention to EBITDA margin. What EBITDA margin means is 20% of what? 20% of revenue, right? So if you have a top line revenue practice of 3 million, then a healthy EBITDA margin is going to be somewhere in the range of 20 to 25%. So your EBITDA is going to be somewhere in the range of, let's say, 5 to 700,000 if your top line revenue is $3 million. If your EBITDA margin is lower than 20%, it's going to impact your valuation, but that might be an opportunity for the DSO to leverage their economies of scale and immediately grow your EBITDA margin post-sale. If your EBITDA margin is exponentially higher than 20%, say it's like 28%, 30%, DSOs might be a little hesitant to bid a premium multiple because they're not going to be able to bring a lot of value to you in regards to leveraging economies of scale and increasing EBITDA post-sale. And they may think their EBITDA margin is unsustainable long-term. So, it cuts both ways. You want to sell at a peak, not a valley. DSOs are paying very close attention to revenue and EBITDA trends because those institutional investors are paying very close attention to same-store sales growth when they get to that recap event. So you want to sell, you want to take your practice to market with a growth narrative. The easiest way to support a growth narrative is to show that your business has been growing year over year from a revenue and EBITDA perspective. DSOs want to grow your business. So you always want to go to market with a growth narrative. Post-closing growth potential will drive demand and will impact the valuation. Doctor alignment and retention. They want you to have ample runway to exit, ideally 5 years before you exit the business. And they want your other providers to have some youth and have some runway to exiting the business. And they want to make sure that your associates are complicit, your minority owners are complicit with a DSO deal. So just understand that at some point in the process, they're going to be involved. And you're going to have to get them on board. You're going to have to sell them on the idea of going the DSO route. And that means that you may have to offer them some type of incentive to do so. So let's talk about practice valuation metrics. What impacts the EBITDA multiple? But before we do that, I want to make the statement that EBITDA is way more important than the multiple. Controlling the narrative regarding EBITDA, getting credit for the highest EBITDA level we possibly can, is the number one way to ensure that you maximize your valuation, because every dollar of EBITDA is worth somewhere in the range of $6 to $9 in value. And that's a big part of the value that we bring to our clients. It's the reason why our back office is super buttoned up. We've got a CPA on staff. We've got financial analysts on staff. Everybody on my team has a finance or banking background, because controlling the narrative regarding your financials and the EBITDA is the key to juicing the valuation. The number one way that DSOs are opportunistic and maybe even predatory is trying to convince doctors that their EBITDA is actually significantly lower than it is, but dangle the carrot of a sexy EBITDA multiple to convince you to sell to them. Well, what do I mean by that? Let's take that top line revenue, $3 million practice, and you call me because your CPA said, hey, you're thinking about selling to a DSO, you've got an offer in hand, you need to call Brandon and his team, gut check the DSO's EBITDA calculation, gut check that DSO's offer. Maybe it's your CPA, maybe it's your attorney, maybe it's your consultant, maybe you found me on a webinar like this. But a lot of our clients come to us with an offer in hand. And they've got that practice with $3 million in top line revenue. And the DSO has said, Doc, your EBITDA is 500,000 and we're going to pay you an 8x multiple, a $4 million valuation. 8x multiple is a premium comparative to what everybody else is paying in this market. You don't need a sell side advisor. You shouldn't shop and talk to other DSOs. We're paying you a premium for your practice. Well, you press pause, you hit timeout, you call me, my team does evaluation, we do an independent EBITDA analysis, and we determine that your EBITDA is not 500,000. Your EBITDA is 700,000. So at a $4 million valuation, the multiple they've offered is not even a 6x. They told you it's an 8x, but it's not even a 6x because 6 times the real EBITDA of 700,000 would result in a valuation of 4.2 million. So that's how they manipulate the numbers to ultimately buy low and be a good shepherd of the capital of their investors. We don't allow that to happen. We control the narrative regarding EBITDA. We're going to get full credit for that $700,000 EBITDA. And then we're going to go to the open market, create what we call a blind bid process, and maximize not only the EBITDA, but also the multiple. So if we can get a 7.5x multiple on that $700,000 in EBITDA, now we're talking a valuation of 5.3 million comparative to that unsolicited offer of 4 million. Simply by controlling the narrative regarding EBITDA, creating a competitive environment, and slightly moving the EBITDA multiple. So I'll get off my high horse, but just understand that controlling the narrative regarding EBITDA is critically important to maximizing your economic outcome in these deals. So what impacts the EBITDA multiple itself? The EBITDA level, there's definitely kind of a pecking order. You can see in the chart here to my on the right-hand side of the screen. You know, if your EBITDA is under $1 million, you're going to trade for somewhere in the 5.5 to 7 times EBITDA range. If your EBITDA is in the $1 million to $2 million range, you're likely going to trade somewhere in the 7 to 8x range. And if your EBITDA is over 2 million, you're going to trade somewhere in that 7.5 to 9x range. We had a question come in. Appreciate the question. So the question was, with EBITDA under $1 million for today's market conditions, I was under the impression that practices are trading for much lower than 5.5 to 7 times EBITDA. That's exactly what DSOs want you to believe. There has been this narrative out there over the past 24 months that valuations are severely depressed. Well, guess who put that narrative in the market? Not me. DSOs put the narrative in the market because they want to buy low and sell high. They are opportunistic. They are not nonprofit organizations. They are going to manipulate the conversation however they can so that they buy low with the opportunity to sell high when they go to recap. So these multiples are real. And I'll go over a couple of case studies of deals that we've recently closed. We closed 7 DSO transactions last month, and every single one of them except one traded for 7x or higher. So those multiples are out there. Now, it depends on a lot of different factors, right? So, you know, how do you stack up when we look at these characteristics? If you don't check any of these boxes, you're probably going to trade on the lower end of that range. If you check all the boxes, you're probably going to trade on the higher end of the range. So the EBITDA level itself is the primary factor that impacts the multiple. The number of doctors, we talked about that previously. The more doctors, the less dependent the practice is on one single provider, typically the higher the multiple. The number of locations, the more locations, typically the higher the multiple, but there's kind of a misnomer here. More locations come with more what? More overhead. So storefronts erode EBITDA. They might move the multiple slightly, but they erode EBITDA. So what do I mean by that? I would much rather take a business to market with single location with top line revenue of 5 million and EBITDA of 1.5 million than a three location practice with top line revenue of 5 million and EBITDA of only a million. The single site office will trade for a higher valuation, although the multi-site office might trade for a slightly higher multiple. At the end of the day, who cares about the multiple? It's the valuation that matters. So just understand that more locations does not necessarily mean a higher valuation. We talked about geography already, the fact that practices in a urban and suburban market will typically garner a higher EBITDA multiple than practices in a tertiary or rural market. Infrastructure. So do you have centralized infrastructure? Most of you likely don't. But we do work with a lot of multi-site practice owners that have built their own infrastructure so that they could scale their business without taking on a DSO or private equity partner. But infrastructure erodes EBITDA. So similar to locations, a practice with centralized infrastructure is likely going to trade for a slightly higher multiple, but that infrastructure is going to weigh on the EBITDA and therefore result in a lower valuation, all other things equal. Payer mix. There's definitely kind of a pecking order when it comes to payer mix. Most DSOs are looking for PPO and or fee for service practices. So if you have a heavy HMO component, CAP component, or Medicaid component, excluding pedo practices, it will weigh on your valuation and demand to some extent. The service mix. Or are you a bread and butter practice with a strong hygiene component that's focused predominantly on crown and bridge? Or are you a super producer with a multi-specialty practice and expanded skill set? In that scenario, that revenue is harder to replicate. You're harder to replace. So therefore, you might see a little bit lower demand and lower multiple. Your post-closing plans are huge, right? What is your runway to exiting the business? What is your age? Younger doctors with a longer runway to exit are going to see more offers and higher offers than doctors that are closer to the tail end of their career. We talked about upside potential. You always want to go to market at a peak, not a valley, and hopefully in a scenario where you can show year over year revenue and EBITDA growth. I know that's been a little difficult over the past couple of years with the inflationary pressure on the practice, especially from a staffing perspective. Hopefully your revenue growth has kept up to at least offset the inflationary pressure on your overhead. And then your personality. So this is a big one, and it's one that surprises most people. Most people think that private equity is all about the money, but again, they look at doctors as partners. They're typically not buying 100% of your business and you're sailing off into the sunset. So we always tell our clients, hey, good cop, bad cop. You're good cop, I'm bad cop. Let me handle all the posturing, all the negotiation. That's my job. Let me deal with the economics, the EBITDA, the competitive environment, the bid process, negotiating the deal structure. My team's got that. That's what we do on a daily basis. We excel at it. You focus on being the most charismatic version of yourself throughout this process. Focus on talking about the passion for your practice, for your staff, for your patients, for clinical dentistry. Focus on getting to know the buyers. Are they going to be a good shepherd of your business? Are they going to be a good partner? If shit hits the fan, do they seem like somebody that you're going to be able to sit down, level with, and find a good resolution to move forward? That's what you should be focused on. Let my team worry about the economics. That's what you're paying us for. And we earn our fee in spades from that standpoint. I had a question come in about practices run by associate doctors where the founder or owner has removed themselves chairside. Maybe they're working not at all chairside or sparingly chairside. That's a good thing. That practice typically has less key man risk because it's not so dependent on the owner on a day-to-day basis. I think the tricky part in that scenario is what is your why, right? Why are you selling? What are your goals? What annual income, personal annual income need do you have to pay your personal expenses? What is your role in the business today? What's your current compensation? What is your role going to be in the business post sale? And what's your compensation going to look like? How is that going to weigh on EBITDA? How is that going to impact the valuation? right? So if you don't play an active role in working chairside in your business, are you going to be compensated post sale? If so, what? How does that weigh on the EBITDA? How does that impact the valuation? And what is going to be your role and responsibility post close? DSO deal structures. So I could literally spend all night talking about unpacking DSO deal structures. But the point I want to make is there's a lot of nuance involved. There's a lot of levers involved in these deals. So traditional DSO deal structure, we don't really see these deal structures very often in the marketplace today. Let's just talk from the standpoint of $1 million valuation. So I'm going to talk through each of these deal structures, assuming the valuation is $1 million. Now, I know most of you have larger practices than that. Valuation could be 5, 10, 15, $20 million. But just for conversation purposes, let's say the valuation is $1 million. A traditional deal structure looks like this. I'm going to value your business at $1 million. I'm going to give you $650,000 cash at close. And then I'm going to put the remaining $350,000 on an earnout over, let's say, a 3 to 5 year window. And I'm going to pay the remaining $350,000 in annual installments over that 3 to 5 year window, contingent upon you maintaining the revenue and or EBITDA of the business and fulfilling your post-closing employment agreement. These deal structures are not very sexy in today's marketplace because there's really no upside, right? There's no equity component. There's no arbitrage opportunity. You're not investing alongside your private equity partner. And you've got to maintain the business just to get the money that they've promised. So most of our clients don't gravitate towards a traditional DSO deal structure, and there's very few DSOs currently using this type of deal structure. A holding company model. This is kind of a traditional private equity deal structure. And this scenario, the business is valued at $1 million. I'm going to give you $700,000 cash at close, and the remaining $300,000 of the value of your company, we're going to invest that $300,000 in stock in the DSO's holding company. So rather than owning practice level equity, you've sold all the EBITDA, all the equity in your business. You now own $300,000 worth of stock in the DSO's holding company, right? So you own a little piece of all the practices that DSO owns. And then if and when you hit a recap event, you're going to have the opportunity to exit that equity in part or in full, hopefully at a handsome return, somewhere in that 2 to 4x return on equity in a 5-year window. It does depend on, if you're in a holding company structure, at what stage of the recap cycle you partner with that DSO. If you partner early in the cycle, your upside on the equity is going to be significant, but your holding time is going to be, could be 4, 5, 6 years. Whereas if you partner with that DSO late in the cycle, the equity has been marked up in value as the DSO has grown and got closer to a recap. Therefore, you're going to pay a premium for that stock, and your return on equity is going to be muted, but your hold time may only be a year or two comparative to your peer that sold to that same DSO 3 years prior. So where you enter the recap cycle in a holding company model dictates what you pay for the stock, how long you're going to have to hold that stock, and what the return on that stock is going to look like at recap. A joint venture model, $1 million valuation. Let's say I'm going to give you $600,000 of that cash at close, and then you're actually going to retain 40% equity in your practice. So I'm going to purchase 60% of your practice, give you $600,000 cash at close, and then you're going to retain 40% equity in your own business, right? So rather than partnering with another clinician, you're partnering with a DSO. Now, the cool part about partnering with a DSO is they have resources that they can bring to bear that another clinician cannot. So they're going to have economies of scale. They're going to be able to help you operate the business via leveraging their infrastructure. They're going to be able to negotiate better reimbursement rates with payers, better pricing with vendors. In this scenario, it's a true partnership model where you retain equity at the practice level. So therefore, you're going to receive 40% of the ongoing EBITDA of the business into perpetuity. But you've got to pay close attention to a few things, because in a joint venture model, the DSO is going to charge a management fee of anywhere between 5 to 10% of revenue in exchange for the economies of scale and the operational support they're going to provide. They could lever the practice with the debt that they incurred to buy the business and pay you that 60% cash up front. There's a lot of nuance involved in a joint venture deal that you've got to unpack. A lot of our younger clients gravitate towards a joint venture because they want to continue to own equity in their business. They want to share in the ongoing EBITDA of the business, and they also want to share in the growth of the business. A hybrid model is a combination of the holding company and joint venture model. So in that scenario, it might be a 60-20-20 deal, 60% cash up front, 20% retained equity in your own business, and $200,000 in stock in the DSO's parent company. So a hybrid model is just a combination of a holding company and joint venture model. In a roll-up scenario, this is not really a legitimate DSO deal structure, but there's a lot of people out there pitching the concept that you can wrap your arms around, duct tape together a bunch of unaffiliated practices, and whereby those practices would have traded individually for 7 times EBITDA. If you duct tape them together and loosely integrate them, you can sell them a year or two later for an exponentially higher multiple, a 12, a 14, a 15x multiple. And all you have to do is pay $50,000 to sign up and pay them a management fee of $5,000 to $10,000 a month, and they're going to deliver this unicorn deal 2 or 3 years down the road. This is death by a million cuts. They're never going to deliver the unicorn outcome because private equity is not stupid. They're going to see through the thin veil of illusion that this is not a truly integrated real DSO. It's a roll up. It is a cobbled together duct tape DSO without true integration and economies of scale. And therefore, private equity is not going to be willing to buy that. They're not going to be willing to pay an elevated multiple. But the person that pitched you on this concept never has to transact because they made $50,000 when you joined, and they're making $5,000 to $10,000 a month from every practice within the portfolio. Do not walk away from anybody pitching the roll-up concept. Run away. This is snake oil. I cannot stress that more. I have been preaching this for the past 3 years. None, zero of the roll-ups that have been pitched to doctors over the past 3 to 5 years have come to fruition. And the people that have been pitching them have made tens of millions of dollars by charging management fees and delivering really nothing in return. So I'll get off my soapbox. I do want to talk just for a minute about strategic versus financial buyers. So strategic buyers is an existing DSO. Most of our clients sell to a DSO rather than selling to private equity directly. But we do have a handful of larger multi-site clients that have EBITDA of 2 million plus that would be a potential platform for a private equity firm that's looking to establish a new DSO. I think there's a misnomer out there that PE buyers pay higher valuations than strategic buyers, than existing DSOs. It is true that PE buyers typically pay a higher multiple than DSO buyers. However, they're typically paying that higher multiple on a lower EBITDA figure because they're either going to inherit your centralized infrastructure that erodes EBITDA, whereas the DSO buyer doesn't need your infrastructure because they already have it. So therefore, they're not going to burden your P&L with that infrastructure. Or the PE buyer is going to have to build infrastructure around you in order for you to be a scalable platform, which again is going to erode EBITDA. So at the end of the day, the valuations from DSO buyers and PE buyers are relatively congruent because the PE buyer is bidding a higher multiple on a lower EBITDA figure because they're factoring in the cost of infrastructure versus the DSO buyer that is bidding a lower multiple on a higher EBITDA figure because they already have the infrastructure and they're not going to layer in those operational costs. All right, so moving on, this is a relatively new slide. I think it's important that you align incentives with your doctor partners and associates. Make sure that if you're having conversations with associates about selling them equity, they're going to remember every word of that conversation, and you better be ready to deliver on that promise. Because pivoting to a DSO sale and pulling the rug out from under an associate who you've had conversations about selling equity to is difficult, especially if they're a primary producer. Because if they're not complicit in the sale, if they're not willing to go with the flow, if and when we take the practice to market and we're ready to ink a deal with the DSO, we're going to have a problem. And you're going to have to likely incentivize them monetarily to sign on with that DSO. So be prepared that if you have primary producers in your practice that are not equity partners, you may have to give them equity or share a piece of that cash at close in the form of a retention bonus at the time you transact with a DSO. But you're going to want to make sure that you've got a unilateral tag along, drag along right, meaning that you can force uh, any of your partners to tag along with you, or you can drag them along with you in a transaction. But again, if they're primary producers and they are not willing to participate in a DSO sale, you're going to have a problem that you have to overcome. Also, understand that more partners means that we have to have consensus among more people. If and when we go to market, you've all got to agree to sell to this at the same time to the same DSO with the same deal structure. That's not always easy. But the reason I want to warn you about this is because we are seeing a phenomenon of minority partners and or associate doctors holding the founder hostage when they're ready to monetize the majority share of the business in a DSO or private equity deal. And they're doing that because they can. So just understand that if your legal agreements are not airtight, if you don't have any type of punitive clause whereby your associate and or your partners are not willing to go with the flow when you're ready to monetize the business in the DSO private equity world, you're going to have a problem. So be very, very thoughtful about who you onboard as an associate, the conversations that you have with them, who you sell or gift equity to, and what your rights are in regards to your remaining equity. So let's unpack the keys to maximizing your outcome at sale. Obviously, you want to position your practice as a Class A asset. The more boxes you check as to what DSOs are looking for, the better outcome you're going to achieve, right? The more offers you're going to have, the higher your EBITDA multiple, the higher your valuation. You've got to choose the right time to take your practice to market. Now, I'm not talking about timing the market. That's a bad idea. I've talked to quite a few clients recently that, are saying, hey, I want to wait another, 12 months for interest rates to go back to where they were in 21 and 22 and for the macroeconomic climate to look the way it did back then so that valuations go up another turn or two of EBITDA. That's not happening. Interest rates are not going back to where they were in 21 and 22, likely in our lifetime. Therefore, I don't expect valuations to go back to where they were in 21 and 22, nor do I expect demand to return to that level. What I can promise is one thing is going to change, and that is over time, taxes are going to go up. So the taxes on your ordinary income are going to go up, and the capital gains tax is eventually going to go up. So sooner rather than later, if you're looking to monetize your business, is the way to think about it. But you also want to choose the right time for your particular business, right? You want to evaluate what is your runway to exit. You want to evaluate your why. What are the reasons that you're looking to pursue a DSO affiliation outside of solely looking at the economic considerations, right? Are you looking to take chips off the table, de-risk, get operational support, get access to the wealth creation opportunity with the equity component? You want to take your practice to market at a peak, not a valley, when you can show year-over-year revenue and EBITDA growth, ideally. You do not want to take your practice to market when you're showing year-over-year revenue and EBITDA decline. You've got to obtain proper representation. It takes a village to get one of these deals done right. So you need a strong sell-side advisor like us to protect you throughout the process and give you objective guidance to create a competitive environment and provide you with as much optionality as possible and then maximize the economics. You've got to have your CPA involved in the conversation to mitigate the tax consequences. You need to have your financial advisor involved to determine, are you at a place in life where you can financially afford to sell? And then how are you going to invest the windfall? How are you going to invest the cash at close? You need to have a great sell side dental attorney involved that is well versed in DSO transactions. And by the way, we're happy to refer you to these people, right? We have long-standing relationships with experienced advisors that we trust. And then you're going to want to involve your spouse. please involve your spouse. We have had multiple clients wait until we get 2 weeks away from closing to tell their spouse. That is crazy. You need to make this decision collectively. Um, Please do not respond to an unsolicited offer. We've already talked about the fact that DSOs are very opportunistic, borderline predatory. Their goal is to buy low and sell high. If you do not have proper representation, you are going to leave money on the table. You risk selling prematurely, selling to the wrong DSO, and potentially accepting a deal structure that's not congruent with your goals. You've got to create a highly competitive environment. You have got to be in a multiple offer situation. And that's the environment that we create. Respectfully, you're one practice, you're good for one deal. We control a lot of the volume in the marketplace. We are good for hundreds of deals. So DSOs treat us and our clients differently than they treat you. You will garner a different level of respect and achieve a different outcome if you walk in the door with us as opposed to walk in the door alone. This is like beating a dead horse, but you got to control the narrative regarding EBITDA. EBITDA is the number one thing that impacts value. Every dollar of EBITDA is worth $6 to $9 in value. And that's a big part of what we do for our clients. And then the devil is in the details. You've got to pay very close attention to the nuance, all the different levers involved in these deals, right? What is your cash at closing? Can they claw it back? What are the repercussions if the practice moves backwards post close or you don't fulfill your employment obligation? Where does the equity lie? Is it holdco equity or practice level equity? If it's holdco equity, how much of that equity can you liquidate at recap? And do you get the parent company multiple? When was the last recap and when's the next recap expected to occur? What's the stock price that you're paying for that equity? Is it fairly valued? If it's joint venture equity, retained practice level equity, what's the management fee, right? Are they going to lever your practice with debt? Is your recap proceeds going to be predicated on your practice level EBITDA? And if so, is that EBITDA going to be burdened by the management fee? Is there a ceiling on the multiple that you receive at recap? Again, when was their last recap? When's their next recap expected to occur? I also want to make the point that everybody focuses on the EBITDA multiple, the upfront valuation, the upfront cash. I would argue that fit and deal structure are as important, if not more important, than the upfront valuation. Yes, we want to maximize the EBITDA. Yes, we want to maximize the multiple. Yes, we want to maximize the valuation. But fit and structure have got to be there or you don't transact. Here's our DSO affiliation process. At the end of the webinar tonight, you're going to see my cell phone number as well as a QR code. I encourage each and every one of you to schedule a confidential discovery call. And many of you have already had discovery calls with. If we haven't talked in a while, I'd love to just have a catch-up call to see how you're doing and talk about where you've been and where you're headed and when is the appropriate time to lean in and give serious consideration to doing evaluation and potentially going to market. But in that discovery call, we're just going to get to know each other. I will ask a few questions about your practice. I'm really going to focus on what is your age? What's your runway to exiting your business? What's your why, right? What gets you excited, gets you out of bed in the morning? What keeps you up at night? What are your goals? And how can we help you achieve them? And if it makes sense, the next phase is to do an EBITDA analysis, to do a valuation, do a deep dive, and quantify what is your practice worth from a private buyer perspective? What is it worth from a DSO perspective? And what are your options, right? What do the different deal structures look like out there? Is now the right time to take the practice to market? The good news is this: you will never feel pressure from us to take your business to market. We take a very soft sell approach. Our job is to educate and then take your practice to market at the ideal time and ensure that you crush the outcome. So you won't feel any pressure from us to sell tomorrow. We're going to give you completely objective guidance. We play the long game in our business, just as you play the long game in your practice, right? You don't sell every patient that walks in the door a $50,000 treatment plan, even if they need it. You're going to build the trust over time. You're going to give the patient the ideal treatment plan, and you're going to do it when they're ready. That's the approach that we take to running our business and advising our clients. So once we get through the EBITDA analysis, the valuation, we're going to go over it together on a Zoom call. and we're going to unpack our findings and then see if it makes sense to do some economic modeling to show you, what are the most common deal structures out there? What would be the global economic impact of you going down the route of selling your practice over a 5-year window? We do all that pre-market. That's part of the valuation process. And let's say, hey, you're ready to go, right? Let's say it makes sense to take your practice to DSO market. At that point, we're going to put the practice out to bid to all the different buyers that we vetted and feel would be a good shepherd of your business and aggressive on bidding on your practice and be well positioned to help you accomplish your goals. We're going to run what we call a blind bid process, essentially a bidding war among as many buyers as possible to create competition and to maximize the valuation. We do the valuation so that we can set a baseline expectation as to what we think we can achieve if and when we go to market. The DSO never knows where we value the business. That's a private conversation between you and me. We are sell side advisors. We don't represent DSOs. We represent you. We represent doctors. So we do the valuation to set expectations, but when we go to market, blind bid process, the DSO never knows where we value the business. And in most cases, we're going to exceed the value expectation we set with our clients. We're going to create that highly competitive environment, help you interview and vet potential buyers. We're going to obtain and compare multiple offers. And then from there, we're going to narrow the field to the top 2 or 3 contenders and decide how we negotiate. Are we going to call for best and final, or is there a clear front runner that we want to negotiate with? We'll ink an LOI and then quarterback the closing process from start to finish, including defending your EBITDA during the quality of earnings process so that the terms we agree to in the letter of intent stay intact throughout the process. And that's a huge part of the value that we bring to our clients. All in, this process takes about 5 to 6 months start to finish. Valuations 2 to 3 weeks. The go-to-market process, soliciting bids, negotiating offers, is about 8 weeks. The closing process is somewhere in the range of 2 to 3 months. So 5 to 6 months start to finish. And if we get through the valuation process and we decide, hey, it's not the right time to take the business to market, we're going to give you some tips, some guidance on what to do with your practice to reverse engineer that outcome you ultimately want to achieve. We're going to stay in touch along the way, and then we'll take the practice to market when it's the right time. Might be a year from now, might be 3 years from now, might be 5 years from now. A couple of case studies, deals that we recently closed. This practice, general dentistry practice in Denver, owner doctor was 55 years old, so close to the tail end of his career. He was selling to de-risk and get operational support. Top line revenue of 4 million, EBITDA of $1 million, really healthy EBITDA margin, 25%. He already had an offer in hand for 6.2 million, but wisely decided to hit pause on that conversation and call us, allow us to do an independent EBITDA analysis and valuation. And we said, hey, 6.2 million, not a bad offer, but we think through leveraging our blind bid process and going to the open market, we can fetch a valuation of 7.2 million. He ultimately trusted us to do that, and we received 7 offers and ultimately closed the deal at a valuation of 7.7 million. That's a 7.7 times EBITDA multiple. In this scenario, we had a 60-30-10 hybrid structure. What that means is the client took 60% cash at close, retained 30% equity in their own business, and then rolled 10% of the value of their business into stock in the DSO's holding company. And they agreed to a 5-year post-closing commitment. So unsolicited offer, 6.2 million. Valuation, 7.2 million. Ultimate outcome, closed at 7.7 million. Guess who it sold to? Sold to the same DSO that made a 6.2 million unsolicited offer. Simply by us walking in the door, creating a competitive environment, control the narrative regarding EBITDA, we were able to juice the valuation by $1.5 million. So despite the fact that the client sold to the same DSO they were already talking to, they sold at a much better economic outcome. This practice, younger doctor in Chicago, 45 years old, selling to obtain operational support to facilitate growth. So this doctor was not really looking to take a step back from his practice. He was looking to lean in and grow his business. Revenue of 5.5 million, EBITDA of 1.5 million. We did evaluation, came in around $10 million. That was the expectation we set with the client. Took it to market, got 5 offers, and ultimately closed at a valuation of over 11 million, a 7.5 times EBITDA multiple with a substantial growth-related earnout. So if the practice grew substantially post-close, our doc would receive additional cash payouts predicated upon hitting certain revenue and EBITDA toll gates. Because he was younger, he took a 60-40 joint venture structure. So 60% cash at close, retain 40% equity in his business on a go forward basis. So he's going to share in the upside growth, both in the ongoing EBITDA distributions as well as in the recap proceeds. Again, a 5-year post closing commitment. In both of these scenarios, neither doctor was working full time chairside when they affiliated with the DSO. Yes, they have a 5-year commitment, but they have to work no more chairside than they're currently working. And the previous doctor, this doctor that was 55, had clear plans to cut back chairside 2 years following closing and step away chairside 3 years following closing. As long as they backfill their production with associate doctors, the DSO is going to give them the autonomy to do that. As I mentioned before, I strongly advise you to schedule a discovery call. If it's the first time we're talking, we're going to spend 30 minutes getting to know each other and decide if it makes sense to do a deep dive, to do evaluation, to do an EBIT analysis and get you educated on your options. If not, if now's not the right time, now at least we know each other, we can stay in touch. And when it is the right time, we'll pull the trigger on evaluation. You can text me. This is my cell phone number to schedule a call, or you can click on this QR code and you can schedule a free consultation via a link on our website. If we've already spoken before, a lot of you have already seen a webinar, you've already seen me on a podcast, maybe we already had a discovery call. I'd love to schedule a quick call just to catch up, talk about how things are going, and chart a course for reverse engineering whatever outcome you're looking to achieve down the road. I'll get to a couple of questions real quick here. How do we get paid? Great question. So we charge a fee for the valuation. It's $2,500 nominal fee. You only pay that fee once, and it's credited towards our commission if and when we consummate a sale. And it doesn't matter when that sale occurs. If it occurs 3 years from now, 5 years from now, 7 years from now, I'm going to credit that $2,500 fee to our commission at close. I also want to mention that if we get through the valuation, you pay the $2,500 and you're not ready to go to market, we will update the valuation in the future at no cost when you are ready to go to market. And the valuation is a valuable tool, not just to show you a snapshot of where you're at today, but you will learn a lot about your practice and we'll be able to give you a lot of consultation regarding if you're not ready to go to market today, here are the 5 to 10 things you need to do to prepare your practice to go to market in the future. We get paid a success fee by you at the time of sale. So our commission on average is 7% of the enterprise value of the practice. Now it can vary depending upon deal size. And on average, our clients are going to receive a 20 to 25% premium for their practice, just as we reviewed in those case studies, comparative to an unsolicited offer. So our goal is to essentially triple our fee in return of an increased valuation at sale. And we're able to do that on a regular basis. That's why we have as many client references as you'd like. That's why we have over 100 5-star reviews on Google. We have a fantastic reputation of delivering value to our clients at the time we transact. I think that wraps it up for tonight. So I appreciate everybody tuning in. Again, highly advise you to schedule a discovery call and look forward to getting to know you and helping you accomplish your goals. Take care and have a great evening. Good night.